Well, good afternoon, everyone, and thank you for joining us for our annual year-end tax and planning opportunities webinar. My name is Bob Ingram. I'm a financial planner here at Center for Financial Planning, and I am joined by my colleague, Michael Brocavich. Michael is also a certified financial planner practitioner that has worked with clients for over 10 years and has served in the financial services industry for over 15 years. And on behalf of our entire center team, we really appreciate your continued confidence and trust as we strive to improve lives through financial planning done right. And we recognize that this time of year, as we approach the end of the year, you're often pulled in so many different directions. So our goal today is to keep on your radar opportunities that may help you save money in this year, or help you position yourself to maximize your resources in 2024 and in the years ahead. And while taxes should not dominate every decision, as a comprehensive financial planning firm, we understand that tax considerations do impact many financial decisions or planning strategies. And many of the opportunities we'll talk about today may be tax related. So just one quick housekeeping item before we go ahead and get started. While we're not going to be able to take questions during today's session, Michael and I really encourage you to write down any questions that you do have and send them to your planner or to either one of us after the webinar. And we'll have contact information for you as we wrap up today. So let's go ahead and get started. So what we'll cover today, things that you need to do before the end of the year. So kind of the deadline of December 31st, things you got to get done, this month. We'll also talk about general strategies and planning opportunities. Some that will be very much in the short term, and then other strategies that will be applicable not just this year, but in coming years as well. With recent legislation, as we know from the end of last year, the Secure Act 2.0, the latest version of the Secure Act legislation that passed late December of 2022, has impacted a number of retirement-related rules and other strategies this year, and will also impact others in the coming year. So we'll talk about what are some of those impacts now, and then some of the things to be on the lookout for over the next couple of years. And then we'll wrap up. We'll have some resources for you to share with you, as well as some next steps to take moving forward. So, Michael, as we get down here to the wire at the end of the year, what are some of the things that we really should be thinking about doing and getting done by the deadline of the 31st?
Yeah, great question, Bob. And thank you for everyone out there that's joining us today. But one of the big things for the year end that we're talking to clients about is their required minimum distributions. So I know a lot of you out there have needed to satisfy these distributions this year. What required minimum distributions are they are just distributions that you need to start taking out of retirement accounts. Now, in the past, the age for this distribution has been 70.5, but there has been some policy changes over the last few years that's really bumped these ages of required distribution out a little bit. So currently, right now, anyone that was born 1950 or earlier, your RMD age is 72 years old. If you were born 1951 or later, you're at 73. And for those of you out there that were born in 1960 or later, your required minimum distribution age is not till age 75. Now, this has been a recent change. So some of you might have been thinking if you were turning 73 in 2024, that you were going to have to take a required distribution. That's no longer the case. That may be pushed out to age 75 for some of you. Now, you need to make sure that you're taking these required minimum distributions because the IRS does impose a penalty if they're not taken. So previously, that penalty was 50% of your required distribution. So if you were required to take a $10,000 distribution and you did not, the IRS could impose a penalty as high as $5,000 or 50% of that distribution. There is still a penalty, but that penalty is now 25% rather than 50%. So they've given us a little bit of a reprieve there, but we still want to make sure that we're taking those distributions in the year that we're supposed to, because those penalties could add up. Now, if this is your first year that you need to take a required minimum distribution, if you are turning 73 next year and are now eligible to start taking that distribution, you need to typically take it before the end of the year. Now, in your first year, you actually have a little bit of a grace period where you have until April 1st of the following year. So if 2024 is your first RMD year, you can wait until up to April of 2025. But remember, you also have to take an RMD in 2025 as well. So waiting till April 1st of the next year to take your first RMD, you could end up having 2 RMDs in 1 year. So you're going to want to make sure that you take your distribution appropriately. Now, where do we need to take our RMDs from? So we need to take our RMDs from our retirement accounts. So those are our SEP IRAs, simple IRAs, 401ks, 403bs, 457. So all of those qualified plans that you've been contributing at through work. Now, if you've consolidated all of your accounts into IRAs, your RMD can be distributed from one of your IRAs and satisfied for all. If you haven't consolidated into IRAs and you have a 401k or some other type of retirement plan out there, you'll likely have to take a couple distributions, one from your IRA and then another from any of your retirement plans that are out there. But there are others that have to take RMDs, not just folks in their 70s. Another required minimum distribution that needs to be taken is for folks that have inherited either IRAs or retirement plans from a loved one. So in the past, if you inherited an IRA from, let's say, your parents or from another family member, you were able to take distributions out of that IRA, but be able to stretch that IRA over your lifetime. So those, you take distributions, but you would take smaller distributions, and that IRA can exist over your life expectancy. Well, over the last couple of years, there's been some changes to that. Now, when you inherit an IRA, the IRA needs to be distributed within 10 years. So anyone that inherited an IRA after December 31st, 2019, the IRA needs to be completely liquidated within 10 years. Now, there are some folks that are exempt from this new 10-year rule. For example, if you're a surviving spouse, so if you inherit your spouse's IRA, you do not fall within these new stretch IRA guidelines. In fact, you can convert that IRA into an IRA in your name, and then all the rules would apply according to your age as a normal retirement plan or IRA that you already own. Now, others that are exempt from the stretch options of 10 years are disabled individuals. They're able to stretch out distributions longer. Minor children are able to stretch it out longer than 10 years. Someone that is chronically ill does not have to fall within the 10-year time frame. And lastly, beneficiaries not more than 10 years younger do not have to fall within those new 10-year stretch rules.
And Michael, I know that we've probably seen a couple of different examples of somebody that might be 10 years younger, because normally you think the next generation, children, grandchildren, which are more than 10 years younger. What are some examples you've seen?
Yeah, so it can be a little bit more unique. For example, if a sibling passed away and you inherited their retirement plan or IRA accounts, they could be within 10 years of you. Or in some cases, we've even seen where ex-spouses are still kept as primary beneficiaries on retirement plans for planning purposes. And in that case, if this ex-spouses had been within 10 years, then they avoid that 10-year rule as well.
But I know, yeah, I'm sorry, but I know the big question sometimes that comes up too, though, with this whole thing is, so if folks that still have to distribute all of the funds within those 10 years, the question is, what does that mean for each and every year? in terms of actual RMDs? What's the requirement, or is there the requirement for taking RMDs if you still have to satisfy clearing everything out within 10 years?
Yeah, that's a great question, Bob. So, there is a little bit of a gray area, but as we know the rules right now, if you inherit an IRA and the individual that you inherited it from had not yet reached the age of required minimum distribution. So if you inherited an IRA or retirement plan from someone and they weren't yet taking RMDs, then yes, you still have to liquidate that account over 10 years, but you can pretty much choose when you want the account to be liquidated. You can take a little bit each year. You can wait till the 10th year and liquidate it all, or you can come up with some other type of liquidation plan that fits within your income and within your financial plan. Now, if the person that was deceased was at the age of RMD, so if you inherited a retirement plan or an IRA from someone that was already taking their required minimum distribution, well, now you are required to take a distribution every year over that 10 years that you inherited it. So you can't just wait to the 10th year. You have to take a distribution each year. Now, the IRS realizes that there is a little bit of confusion here. So they've actually suspended the tax penalty on this. Remember, you get a 25% tax penalty if you missed your required distribution. But the IRS has said, look, we understand that there's a little bit of confusion around this rule. So if you inherited an IRA and you were required to take a required minimum distribution in 2021, 22, or even 2023, you won't have to worry about a tax penalty. The IRS has given us a reprieve for those years, and they're saying it's okay. But starting in 2024, you're going to want to start to take distributions out of that account. So now, Bob, not everybody out there is required to have distributions out of retirement plans, but they are coming up with changes to being able to contribute to their existing retirement plans. So what are some changes, or what should people look out for with contributing to retirement plans this year and going forward?
Yeah, so with for 2023, if you're working and contributing to your employer plan, of course, if you're under age 50, you can contribute up to the maximum of 22,500, which is an increase of a few thousands from last year, from 2022. And some of the other plans like simple IRA, maximum of 15,500, and then even your traditional and regular Roth IRAs, you can contribute 6,500. And then for catch-up contributions, again, for folks over age 50, you can actually contribute a little bit more. So for a regular 401k, 403b, 457 employer plans, an additional 7,500. So that brings up the total of 30,000. And then for simple IRAs, it adds another few thousand. So the total is 19,000. So a lot more can be contributed, of course, for folks over age 50. Now, if you're not on track to either maximize it like you were hoping to, or even if you set a target for yourself for the year and you're maybe not quite at that target, to hit that by the end of December, then there's the possibility, if your plan allows for it and your financial situation allows for it, you can really try to super save, or what we call power save, for the rest of the year. So the rest of the month, if you have a payroll, one or two or more payroll checks, and you can put as much of the payroll check toward your plan, you could increase that plan contribution amount and try to sock a little bit more away, just to get play a little bit of catch up for yourself toward your objectives. Particularly if you have a good cash reserve and savings account, where you can, instead of getting money to live on from your paycheck, if most of all that's going to go to the 401k or your other retirement plan, you can then draw funds from your savings to live on, instead of from the payroll check. So works really well for reserves. Great reason why having a good cash reserve and for emergencies and opportunities is a good part of a great financial plan. And then other considerations, of course, would be of where you're contributing funds. So plans that have both a pre-tax option, your traditional 401k or retirement plan where funds go in pre-tax, you're getting to reduce your current income So it's beneficial in this current tax year to lower taxes. The other side would be to contribute after tax if it's available to a Roth plan, which is you don't get to reduce your current income. Again, you're paying after tax dollars into the plan, but in the future, all of the growth and the earnings going forward are all tax free. So the compounding effect of not having to pay taxes and all that growth, all those earnings, can be a very powerful thing over time, particularly for individuals that have a long time to still contribute and build and save. Many times, if you look at your situation and you're going to have being in a higher tax bracket later, it can make sense to pay the taxes now, put as much as you can under the Roth side, and then have all that growth tax free. So when you may be in a higher tax bracket later on, you can pull more funds from the Roth side and not have it subject to taxes. So a lot of it depends on the planning of where you think your income is now. Where do we expect tax rates to potentially go in the future versus now? So a little bit of art and science to the decision, but if plans offer both, certainly something to be evaluating each and every year. And certainly now is a good time for it, especially as we think about 2024 and position yourself to have a good savings track and to hit your targets for next year. So for next year, 2024, we've just seen the recently announced contribution limits. Nothing earth-shattering here. It was an increase of about $500 a year. So for 401k, 403b, 457, for example, it goes from 22,500 to 23,000. And then simple IRA from 15,500 to 16,000. And then the traditional and Roth IRAs are increased 500 to 7,000. And then, of course, if you're over age 50, the catch-up contributions actually remain the same this coming year. So the same in 2024 as they were in 2023. So good plan for there. But in addition to thinking about your retirement plans and your savings contributions, there are probably some other things as far as your employee benefits and even from a healthcare perspective, right, Michael, that you should be looking at and some decisions you might have to make?
Yeah, absolutely. So, folks have a couple health savings accounts that we want to talk about next that you're going to want to pay attention to here at the end of the year. So you likely have one of these two options through your employer. You're either probably in a health savings account or a flexible spending account. Now, both of these types of accounts help you to accomplish the same thing. You can put in pre-tax dollars into the accounts, and then when you spend money out of the accounts, if you spend them on qualified medical expenses, everything comes out of them 100% tax-free. So these are great accounts to be able to save to help you with medical expenses. Now, if you have a health savings account through work or an HSA, it's probably because you have a high deductible plan, health savings or a health plan through work. Now, the advantage of the HSA is that it is the only account out there that is actually triple tax advantaged. And why is it triple tax advantage? Because you get a tax deduction when you're adding money into the account. So you're putting pre-tax money in. The account can grow tax deferred, as within an HSA, you're able to invest additional cash you have in the account. And then lastly, if you're using the money for qualified medical expenses, everything comes out of the account tax-free. So it's different than any other type of account out there. A Roth IRA would probably be the next closest to it. But when you're adding money into a Roth IRA, you're putting in after-tax dollars. So it's really only double tax advantage, not the triple like the health savings account. So if you do have a health savings account, you want to make sure that you've maxed it out for this year because that triple tax advantage will be helpful not only for you now, but also into retirement. The health savings account is an account that you get to take with you. You own it as an employee. If you leave your employer or you retire, you're able to take this cash value and this account with you to be able to spend throughout retirement. Now, on the other side, we have the flexible spending account. The big difference with the flexible spending account is that you cannot carry money over in this account. It's sort of a use it or lose it type of account. If you have a flexible spending, likely, you've been able to have the advantage of a lower deductible health plan. But with this account, when you're adding money into it, you still get the tax deduction. So you're adding pre-tax money. The money that comes out for qualified medical expenses comes out 100% tax-free. However, you don't get to maintain a cash balance, and you don't get to invest the cash balance over time. So at the end of the year, you need to look at these flexible spending accounts right now and see, do I have money still left in this account? And if you do, you're going to want to spend that money before the end of the year, or else you could potentially lose it. Now, there are a few flexible spending accounts out there that will allow you to roll over a small balance. Right now, that maximum is about $610. So you can check with your employer to see if you're eligible to roll over a small balance. But if not, you're going to want to make sure that you're taking those distributions out of that account before the end of the year. Now, Bob, a lot of this stuff people are looking at while they're at their employer open enrollment. But Medicare folks have an open enrollment as well. I know we're getting towards the end of it, but are there some choices some Medicare folks might have to take?
Yeah, so we are. It's just down to the wire here in the last days before the end of open enrollment, the main open enrollment, which ends on the 7th. And yes, you certainly can make your decisions as far as changing plans, looking out to projecting what the costs are likely to be next year. Again, the most very recently announced premiums for 2024. So this chart kind of shows an example of what those will look like next year. So the first line you can see is kind of the baseline premium. So it's based on income. So everybody is going to pay that first amount at least $174.70 next year. Now it's based on income. So there's a certain threshold. So as an example, filing individually, so anybody making 103,000 of modified adjusted gross income or less pays that. If they're above that, they may go into the next premium tier. And then above that threshold, they would go into the next premium tier and so on. So just again, filing jointly, a couple can make up to 206,000, and then a couple married filing separately, the maximum would be 103,000 for that first baseline premium. Otherwise, you'd be subject to those additional Medicare surcharge premium costs. And again, it's always looking backward. So the premiums for 2024 will look at what your 2022 income was. So it's 2 years of a look back. So when you're trying to plan different strategies that could impact income, Medicare premiums is certainly something we think about a lot, right, Michael? We think about, could you push yourself into a next premium tier by doing things that could increase your adjusted gross income? So it's certainly a factor to consider, and it's a little bit of a moving target because we'll never know exactly what the premiums will be based on the current year because we're always 2 years behind. So being conservative, thinking about at least what the premiums were in 2022 can kind of guide decisions for 2023 and then income decisions going into 2024. But in addition to that, another thing besides looking at premiums and health plans and savings plans through the employer, just overall investments, right, Michael? This is a good time of year to be thinking about investments and what are some ways to not only improve overall investment performance, but also from a tax perspective as well.
Yeah, that's absolutely right, Bob. So it's no secret to anybody out there that we have seen a lot of volatility in the market in the last couple of years. We did not have a great 2022 financial market, and 2023 has not been much better. I mean, we've seen some positive returns on the S&P 500, but outside of maybe 7 mega cap stocks on the S&P, it was really hard to get returns out there. So what we want to talk about now is looking at your investment portfolio, and these are your investments that are not in retirement accounts. So these are investments that you may have to pay taxes on it, either capital gains taxes or dividend taxes on dividend income. These assets are generally invested in brokerage accounts and trusts. But right now is a great opportunity to be able to look at these accounts and help to make them a little bit more tax efficient. If there is any silver lining whatsoever with market volatility and down markets, is we have the ability to really take a deep dive into our portfolio, look at investments that we have received losses on, and be able to sell those investments and realize losses. So this is called tax loss harvesting. And what we can do is we could sell an investment that may be at a loss right now, and then immediately take those funds and reinvest it into something similar. So that way the money stays invested, but you're able to realize a tax loss to offset against other capital gains in the future. So when you realize these tax losses, if you have capital gains in the year in which you realize them, then those losses can offset against those gains. If you don't have capital gains in a year and to offset against those losses, the nice thing is those losses can accumulate and they can carry over on your tax return. So if you're not using them this year, then you're able to use them in future years when you realize capital gains. Now, with the advantages of being able to do some tax loss harvesting, we might even start to do some gain harvesting. All right. So this is a little bit different. So we're intentionally realizing capital gains to pay taxes. Now, we want to do this if we've been able to realize some losses. So if we've been able to bank some losses, now would be a good time to trim some of those highly appreciated positions that maybe you've been hesitant to trim in the past because you didn't want to pay the capital gains taxes. If you have some losses offset against that, that could be very helpful to you. If the market's down a little bit, that highly appreciated asset may not be as appreciated as it was, may be a good time to kind of sell it off and reposition it into something that you're confident will have better growth going forward. So there's a lot of ways that we can be looking at our portfolios and making them a little bit more tax efficient. Now, Bob, if somebody is charitable and they have some appreciated positions, is there something that they might be able to do in order to get some tax benefits there?
Yes, absolutely. So, one of the things we do like to talk about, and it's always good reminder to go through year end, is for those that are charitable with appreciated securities, gifting the actual appreciated securities as opposed to just gifting cash can make a lot of sense for a couple different reasons. So one, just like a cash gift, it may be tax deductible. If you're itemizing your deductions and you give to charity, those amounts can contribute to your list of itemized deductions. So if you are itemizing, you can get a potential tax deduction. And for appreciated securities, there is a maximum annual amount that you can actually deduct, and it's up to 30% of your adjusted gross income. So if it happens to be you've gifted more than that, it doesn't completely go away. You don't lose it. It does carry over to the next year. So if it's above the 30%, you can use some of it the next year. So that's one benefit if you're able to get those deductions. The second, though, is that you can avoid the capital gains on a potential security sale. So if you have appreciated securities that you maybe haven't wanted to sell for a while because you haven't wanted to pay those gains, and they've been building up and building up, and then you figure at some point you're going to have to bite the bullet and pay those gains, gifting the securities literally takes those gains out of your ownership. You don't have to worry about those gains anymore. You've gifted them, and because the qualified charity has a tax status where they don't need to claim the gains as taxable income either, it's a great win-win. So two benefits there for doing that. And really, even if you're not itemizing, it can still make sense to gift securities because of that benefit of just being able to remove those gains from your ownership. So while there's a great benefit if you're getting the deduction and removing, it still can make a lot of sense if you're not. Now, the flip side would be, well, you might say, Bob, why would you gift, or how would you gift if you have securities that might be slightly down in value? I know Michael, you were talking about tax loss harvesting in a time where you may have some short-term losses. In this case, it's really the opposite. You would not gift the securities that are down in value, because at that point you're eliminating or getting rid of the ability to take a loss. So in this particular case, if you were going to create cash proceeds to gift, it could make sense to sell the security at a loss to get the harvested loss, which you could then apply to other gains to offset, or just have the loss build up for you, and then take the cash proceeds and just gift the cash at that point. So it's not gifting the security if it's lost property. It really would be combining that with the strategy of harvesting losses. And then again, capital losses would offset gains, potentially offset some regular ordinary income up to that limit, and then potentially carry forward. So
Yeah,
it can
Bob,
be
this is a great strategy to allow clients, to be charitable, while also getting rid of highly appreciated positions. But you mentioned, that standard deduction, and when we talk with a lot of clients, we always kind of come up to the hurdle of the new standard deduction that could be, 28,000, maybe even 29,000 for folks out there. Is there anything that we could do to help overcome this high standard deduction?
Yeah, one of the things that we talk a lot with clients about is if they're in that situation where they're charitably giving regularly, let's say every year a certain amount. Well, one thing that you could do is consider bunching or lumping together multiple years worth of gifts, gifting it all in a particular calendar year or tax year in an amount that gets you over that hurdle, that's higher than the standard deduction. So if we kind of take a look at just a simple case of that, it's just a hypothetical. Let's say clients, a couple, Joe and Janice, they're 62, they're currently working, and they have adjusted gross income of 200,000 this year. And they typically give 5,000 a year to charity. Now, next year they plan to retire. So, based on their financial plan, they figure that they could actually live on an income of 120,000. So they're likely to see their income go down in future years when they do retire. And with their standard deduction this year, let's say it's 27,700, and their expected itemized deductions are under this threshold. So as of now, they're not going to really clear that hurdle. They would likely not itemize to get that any additional benefit from the charitable gift, at least making the charitable gift deductible for them. So one of the things that they could do, what if they just bunch together 10 years worth of their $5,000 gift and gifted $50,000 in this single tax year? That plus any other of deductions that they might have would be above that threshold of the 27,700 standard deduction. They can get the full deduction on that 50,000, and especially try to maximize the fact that their income is likely to be the highest. Their $200,000 income is likely to go down. So if they can reduce that current income of 200,000 through a real large charitable gift, that can help this year's taxes and then set them up well for going forward when their income is a little bit lower. So they're able to clear that hurdle and actually take advantage of the tax benefit of that gift in this particular case. So it's kind of, again, a good benefit for doing that.
Yeah, this is a great strategy, Bob. A lot of clients, though, they may not want to give that much to charity all in one year. They still want to kind of spread these distributions out to the charity, but want to be able to take advantage of a strategy like this. Do we have a solution for those clients?
Yeah, as a matter of fact, we do, Michael. There's a couple of ways that they could do it. So we've talked about this, of course, in the past, but it's always good to put this in the context that there's a strategy called the donor advised fund that clients can use, and can be a really effective tool for gifting. And we'll talk about a few reasons again, but what it is, it's literally a program sponsored by a custodian that sets up literally a fund that is in of itself a public charity. So the donor advised fund established through the custodian is a qualified charity. So what does that mean? Well, by making gifts to the fund itself a qualified charity, that is a deductible gift. That is a potentially tax deductible gift. So it is a qualified charitable gift, when it's made to the fund. Not even talking about gifts to the charities yet. So individual makes that gift to the donor advised fund. Once it's in that donor advised fund, it can be growing over time. So the fund can still exist and build and grow, and they can continue to contribute to that. And then the initiator, the grantor, can say, well, I'd like to request grants come out of the donor advised fund and go to the charity of my choice. And again, it's a request. You've made an irrevocable qualified gift to the donor advised fund. So it's not your money. It's technically not your money any longer. It's the fund's money, but you can request and direct gifts as long as the destination charity is a tax qualified organization. Usually works really well. There's not usually a problem with that. So it can work well for someone that wants to still choose when and how to gift to the charities, but maybe they want to lump or bunch together multiple years gifting. Well, they'll gift to the donor advised fund. So in the case of our client couple there, instead, if they wanted to make that $50,000 gift, they could gift to their donor advised fund, take advantage of the potential tax deductibility this year for that $50,000. And then when they decide to make $5,000 a year of their annual gifting each year, they just go to the donor advised fund, request the gift or request the grants to be made. So they still have that control. So the balance can invest, and they have the control of when the gifts to be made are made when when it really does make sense. So again,
This is a great strategy, Bob, and allows people to basically, what you're saying is, create their own personal family foundation and then be able to give charitably from that foundation throughout their retirement.
Yeah, it is a type of a version of that. It's just a simplified way. They don't have to have a board, and they don't have to organize an actual foundation and a lot of the administration involved. It can be again a simpler way to do that.
That's great. Now, a lot of folks, though, they maybe not have appreciated securities that they're able to give. Is there any other options, for those older folks out there that are in retirement, to be able to give charitably?
Yeah, the other strategy we do talk about for retiree clients, particularly those that are in their 70s and above, is of course a qualified charitable distribution, or of course we love acronyms in finance, QCDs. But what a qualified charitable distribution is, it is a direct gift, a charitable gift made directly from a person's IRA account. So, and that's a key point. The distribution to the charity is made directly from the IRA. So you as the IRA owner doesn't take a distribution, have the cash, have that distribution payable to themselves, and then they go ahead and write the check. That would be a regular distribution. The actual distribution is sent from the IRA to the charity directly. You never take possession of the funds yourself. And it does have to come from an IRA. So as of now, unfortunately, this isn't available to be payable from a retirement plan like a 401k, 403b. The IRA holder has to be at least age 70 and a half. Now, interestingly, we talked about earlier, you mentioned the required minimum distribution age and how it has increased the last few years from 70 and a half to 72, now 73, and it will even go to 75. So far under current legislation, they have not pushed up the age for qualified charitable distribution. So it is still available to someone 70 and a half, even though those individuals may not be in required minimum distribution status yet. It can work really well for someone that's taking their RMD, because then they have to take the funds out anyway. So if they're able to send those funds to their charities of choice, if they're charitable and are going to gift anyway, use some of those RMD dollars. It qualifies for the RMD, so it counts. So use it as part of the RMD. It can be a great way to satisfy your RMDs for the year by gifting. And there is a maximum. It's $100,000 a year that you could actually gift directly from the IRA for qualified charitable distribution. And then, interestingly enough, the Secure Act One of the another impact of the Secure Act 2.0 this year, the legislation coming into effect, is that it is now going to index that cap. So the 100,000 will increase with inflation starting next year. So going into 2024, the limit will be 105,000, and then it will increase, based on their inflation factors going forward from there. So we'll only see that grow in the coming years. But I know, Michael, with distributions and thinking about tax efficient distributions, we certainly love to be able to take funds in a tax efficient way, particularly a tax free way, and not have to pay taxes on distributions. So, what are some other strategies as we kind of near the finish line here on a couple of things? What else can we do to be thinking about as far as tax efficient or tax free distribution planning?
Yeah, thanks, Bob. So we all love the Roth IRA concept. Being able to put in money, have it grow tax deferred, and then have the distributions out of that account come out 100% tax free. And if you pass those assets on to your heirs, the heirs even inherit it 100% tax free. So we really love these Roth accounts. The problem with Roth accounts is not everybody can add to them. So you have income restrictions that prevent a lot of folks from being able to add to them in retirement. So what we want to talk about is some strategies to try and get more money into Roth IRAs. So one strategy I want to talk about is the Roth IRA conversion. All right. So what that is simply doing is you're taking pre-tax funds out of your traditional IRA and you're simply converting it over to a Roth IRA. And when you do that conversion, you pay taxes on that distribution. So when it comes out of your traditional IRA, goes into the Roth, that's a taxable distribution event, and you need to pay the taxes on it in that year. So why would we want to do that if we're paying taxes on that distribution just to get it into our Roth IRA? Well, once you get it into the Roth, there's a lot of advantages there. So some reasons why we'd want to do it is, like I said previously, Roth IRAs offer tax-deferred growth and tax-free withdrawals. So that's federal tax-free, state tax-free, and then when your kids inherit it, it's tax-free to them as well. The next is if you expect taxes on your IRA distributions to be higher in the future. So a lot of clients that we're working with, when they first start retirement, we're looking at delaying Social Security or maybe even delaying a pension if you have it at the beginning of retirement, which puts you in a pretty low tax bracket. What we can do during that time is we could what you call fill up those lower tax brackets. So you can convert money at low tax rates today instead of having to pay higher tax rates when you take that money out of your IRA in the future. So it could make sense for you to convert at a lower tax bracket today if you feel like you're going to be in a higher tax bracket down the road. Also, you want to be able to have diversity in the types of accounts that you have and the taxability of those accounts. Having Roth assets is nice in retirement because that's an account that you can go to if you want to take a larger distribution, but you don't want to have to worry about paying taxes on all that. If you wanted to go on a $20,000 vacation, you could take that out of your Roth IRA and you wouldn't have to worry about paying taxes. Where if you took a $20,000 out of your traditional IRA, you might have to take 25, 30, or even 35,000, depending on your tax bracket, in order to get that 20,000 that you need. And then lastly, putting money into your Roth IRA helps with flexibility, tax flexibility for your heirs. So as we've stated before, when your heirs inherit your IRAs, whether that's a traditional IRA or Roth IRA, they still need to distribute that account over 10 years. The Roth IRA really isn't going to have like a required distribution for them, but they're going to have to get that out of the account over 10 years. The nice thing about the Roth, though, is that's going to be 100% tax-free for them.
Yeah, Michael, in terms of, besides, kind of a conversion of regular contributions, there's some other strategies that are still available right? Some kind of some unique strategies that people can take advantage of at this point as well for getting money into Roths.
Yeah, that's correct, Bob. So, this Roth IRA conversion strategy is generally for when you're entering retirement or you feel like you're in a low tax bracket in a particular year. But, there are some strategies for folks out there that are currently employed and they're trying to get as much money as they possibly can into their Roth IRA. So there are some strategies that we can evoke that kind of gets around that high income threshold that we have in order to make direct contributions to a Roth IRA. So a strategy that we could do is where we can convert non-deductible contributions to an IRA immediately to a Roth. So if you're an individual that is a high income earner and you're not able to just make a direct contribution to your Roth, what you could do is you can open up a traditional IRA. You can make a non-deductible contribution to that IRA. And then in the same tax year, you convert those funds immediately into a Roth. Now, since you didn't get a deduction for that IRA contribution, there is not a taxable event that occurs with the conversion like we described in the previous slide, where it was coming from an IRA account that already had pre-tax money in it. So you're going to want to keep track of this, because if you do have an IRA with pre-tax money in it, this solution may not be a solution for you. However, there's another opportunity, which is called a mega backdoor Roth. So what this is for folks that are currently contributing to their retirement plans through work. For example, if you're contributing to a 401k and you're maxing that 401k out on a pre-tax basis, you could see if your 401k would allow for after-tax contribution as well. So some 401k plans will allow you, after you've maxed out your pre-tax, allow you to add after-tax contributions. So you don't get the tax deduction for those, but you're still able to add those into your 401k. Those monies are going to grow, they're going to be invested. And then at retirement, what you do is when you roll your 401k into a traditional IRA, the pre-tax money out of your 401k would go to a regular IRA. And then the after-tax contributions that you've added to that 401k can get rolled over into a Roth IRA. So they call this a mega backdoor Roth because it gives you the opportunity to really convert a lot of money to Roth assets through your 401k.
And Michael, interestingly, with that, not to be confused with the after-tax bucket with the Roth 401k bucket. There could very well be a plan that has a pre-tax and Roth plan, and this would be separate. The after-tax is even a separate whole bucket as part of the plan. I know that sometimes that does come up in talking with clients about this, that it's a whole other bucket that may or may not be available. It's very plan specific, right?
Yeah, that's a great point, Bob, because some plans do offer you to make Roth contributions, but based on your financial plan and your savings, your current tax bracket, you may not want to put a bunch of money into your Roth 401k. You'd rather put pre-tax money in there because you're in a pretty high tax bracket and you feel like you might be in a lower tax bracket once you get into retirement. So this strategy allows you to still maximize that pre-tax, but then also put some after-tax money in your 401k that could later be converted into Roth assets. And now, Bob, with the Secure Act 2.0, there's been some changes that will allow people to add money to Roth IRAs in a couple other ways as well. So when we're looking at these new changes that are going to be taking effect, one change is employer retirement plan matching contributions. So in the past, if your employer offered a Roth 401k option and you contributed to that Roth 401k option, your employer always had to make your matching contributions to your pre-tax 401k account. So folks that wanted to save in Roths, when they got their statements, they would have money in the Roth 401k, but they would always have pre-tax money as well, because that's where employers needed to make their contributions. Well, there's a rule change where employers can choose to make matching contributions to go to that Roth 401k account. Now, this is going to be up to your employer. The employer plan needs to be able to allow for it, but the employer can now start to offer that if they decide that they want to be able to start offering that for employees. Other ways to get money into Roth, for those of you that are self-employed, SEP IRA and simple IRAs can now accept Roths. So that's a big change from previous. SEP IRAs and simple IRAs traditionally have always been only pre-tax dollars. But now folks can open up a simple IRA and they can make Roth IRA contributions to it, as well as pre-tax IRA contributions. And so this allows them to be able to get over that income threshold for folks that are self-employed. And then lastly, a big change on the 529 college savings account front. Those 529 accounts that are out there that may have been a little bit overfunded for college, you can now roll part of those funds over to a Roth IRA. Now you're limited to a lifetime maximum of only $35,000, and there are annual limitations of how much that you could roll from your 529 to a Roth. But this could be a great strategy for folks out there that have 529 plans that either they have additional funds in there after college is complete, or maybe we're just thinking ahead and planning for your child down the road, where maybe we overfund the 529, but we know that there's too much in there to pay for college, but there's some money left over at the end to potentially start a Roth IRA for that student as well. So Bob, we've seen some changes throughout this presentation brought on by Secure Act 2.0. We've kind of talked about in some areas where this Secure Act has really made changes to how much we can contribute, where we can contribute, whether it's Roth, whether it's pre-tax. Are there any other changes from Secure Act 2.0 that we need to keep on our radar?
Yeah, there is actually quite a few provisions, and we could actually be here for more than hours on end going through all of the minutiae of it. But a few notable additional provisions, particularly around retirement plans. So one of the provisions will be for catch-up contributions. So again, those right now we know over age 50 can make additional contributions to retirement plans and even to regular individual retirement accounts, Roth IRAs and regular IRAs. For folks that are specifically 60 to 63, starting in 2025, there'll be additional, so an increased catch-up contribution amount, specifically for the folks that are in that age group. So the catch-up will be 150% of the 2024 regular catch-up amount. Gotta love how the simplicity of this, right? But in seriousness, what that would be, so we know 7,500 is the 2024 catch-up amount. So as an example, 150% of that should be about 11,250. And then it'll adjust for inflation. So every year it'll be something to watch how much that will be. So that's a nice additional amount that folks in their early 60s, kind of that in the, maybe the home stretch of retirement, can make some extra contributions. The other will be around where the contributions for catch-up go. So you said that some plans are going to be allowed to offer matching contributions in a Roth position. This provision of the Secure Act 2.0 actually says that catch-up contributions for certain folks based on income will actually have to go to a Roth 401k or Roth side of the retirement plan, which is interesting. So if wages for the employer for the prior year exceed 145,000, then those catch-up contributions that employee would make have to go to the Roth side, which means after tax. So they're not getting the benefit of lowering their current year's taxes by putting things in pre-tax. They'd be paying the taxes, making the contributions to the extra catch-up contributions to the Roth side. Now, there's obviously, been a lot of questions. Well, what does that mean for employer plans? That would imply that employer plans would have to have a Roth 401k offering in order to require that catch-up contributions go in there. So that's a whole, controversial issue that basically they've delayed it another couple of years. So this provision has been delayed at least until 2026. So one of the things we'll be watching over the next couple of years to see how that plays out and how employer plans can adjust to that new potential environment. And then just a few other exceptions to the early withdrawal penalty are notable as far as provisions to Secure Act 2.0. So, for example, terminally ill and individuals, they actually have an unlimited exemption, an exception for how much they can take from the retirement plan pre-age 59 and a half. So normally, if you're under age 59 and a half, you take a distribution or withdrawal, you could be subject to the 10% penalty. Well, the exception is an unlimited amount if you're terminally ill, and that's effective this year. For certain financial emergencies, up to $1,000 is exempt. So you can take that not have that $1,000 subject to that 10% penalty. And that goes into effect next year. Victims of domestic abuse that need funds can take up to $10,000 from their retirement plan, before age 59 and a half, and would not be subject to that 10% early withdrawal penalty. And in fact, if they'd like to make contributions back to essentially repay themselves, put that money back in, they can do that with up to 3 years, and actually get those funds back in there, and it doesn't change their normal contributions that they'd be making if they are making contributions. And then finally, long-term care costs. You can actually take out up to $2,500 for long-term care related costs and not be subject to the early withdrawal penalty. So exceptions probably not happening often, but they're notable for those circumstances that where people may face these things.
So, Bob, we've gone over a lot today, and there's a lot of changes and a lot of things that folks have to be thinking about. It's very important to their financial plans and their tax plans and how they handle some of this stuff. So what are next steps for people listening on to this webinar?
Well, first thing is, if you have questions, like we said at the very beginning, please don't hesitate. Please reach out to us. Hopefully you've jotted down some notes and got some good questions. Reach out to your individual planners. Certainly, if you're new and introduced to the center, feel free to reach out to Michael or myself. We can be reached at our email address is right there. Anyone that would like to sit down and just have a more one-to-one conversation, we're very, very happy to do a complimentary 30 to 60-minute consultation meeting, either in person or a virtual meeting or by phone. Just discuss your situation, answer questions, and look at how some of these strategies may apply to you, and if there's ways that we can be a good resource for you. So other resources, go in and to our website. You can go to the contact page and receive our tax and planning guide that has a lot of these kinds of related information, strategies, due dates, important numbers. Receive our monthly newsletter that gets sent out and be up to date with different events. You can also right now, if you use the QR codes. So if you want to take a quick snapshot of those QR codes, it'll send a direct link to that page. Same thing for our blog, the Money Centered blog at centerfinplan.com on our blog page. And then finally, stay tuned for upcoming events, future webinars. Going into 2024, we are really excited for the content that we've started to plan for. Our team has worked really hard to put together some great potential events and already education events and other events throughout the year. So stay tuned to hear more about that. Follow us again on social media as well as on our website. And again, if we can do anything to be a resource, please don't hesitate to reach out. But with that, we want to thank you so much again for your time today, your trust and confidence in the center team, and have a wonderful, happy, and healthy holiday season.
Thanks, everyone.